Hey guys, welcome back to the Capital Mindset Show. Today we're going to be reviewing another portfolio, and this was actually requested quite a long time ago, but it just won the runner-up vote from the Discord community, which is, by the way, free to join, for you to have your voice heard on that. I will be actually going over Joseph Carlson's portfolio. So we have reviewed, just to kind of recap, we reviewed Everything Money, Financial Education Jeremy, The Popular Investor, and now Joseph Carlson. So Joseph Carlson, though, has been featured on the channel here and there with regards to Netflix for obvious reasons. We'll actually get into that. And there are two portfolios in question that we are going to review. However, I want to also stress that we're going to watch, or we're going to look at an updated variation of the portfolio, as well as the we're less up to date, actually, if we're being precise in our definition. So less up to date and more up to date, to kind of see how things have changed. Okay, so with that being said, we're going to get right into this. I'm only going to showcase a little bit about what he said. I've been watching his videos for the past 4 or 5 days, trying to get an idea of how this individual thinks, what it is that they value in a particular stock, and why it is that they might invest in that stock. Now, some preliminary thoughts I'll tell you right now is that this individual is kind of like the opposite of Everything Money. He focuses nearly entirely, on the story-driven aspects of investing. Okay, so with that being said, something like Everything Money focused entirely on the analytical aspects of investing. And there are weaknesses and drawbacks, and I've addressed that in the Everything Money review or portfolio review. You guys can go check that out, where I did state that I believe that their portfolio would underperform, or their investment picks would underperform. Something like a Carnival Cruise Line that they, I guess, did not understand certain nuances. Same with Smith & Wesson. Live on the Capital Mindset Show lives, someone requested a stock that was being promoted or talked about, not necessarily promoted, I want to be careful with my words, but talked about by them, and it was Sleep Number. And then they stated in their videos several times, because they did several videos on it, that the liabilities, they didn't have any debt, and that was not a problem. And then we found live that they did have debt, because they didn't read the balance sheet, I guess. So, that's the fatal flaw if you make a mistake, if you're just an analytical investor and you can't even do the analytical side, a little bit of a problem there. But this individual does primarily the story side. And the benefits of a story-driven investing style is because you start to really develop relationships with the company. Of course, this can blind you and make you over-reliant on the story aspect, and then you don't look at the price. And then the common flaw that occurs here is that investors that focus primarily on the story-driven aspect pay nosebleed prices. Now, easier said than done to have a good evaluation process, because there is a reason why this is a difficult thing to achieve. We'll be comparing his performance relative to the S&P 500. So let's take a look first at the performance, and actually, I'll state or show a problem that I am having. So if you see this, if I reload this, well, even the newer ones. So let's take the newer ones. This is taken from his new video. It doesn't show the relative performance or potential performance of $100. It's something weird going on with M1 Finance, which M1 Finance is a fantastic platform. It's just not working well with me right now. So we're going to be going over his videos, and let's see here. So this one is his story fund. It's the most up-to-date one, May 18th, 2022. It is down 52.28% over the course of since July 28, 2020. And you don't want to pay attention to the value over time. The value over time takes into account money being contributed, so it still looks like it's doing great because he keeps putting more money into it. Okay, so the return is what, and he's not hiding this. So I got to give him credit where credit is due. He's not hiding any of this. So transparent, yes, absolutely. So when we see let's actually take a look at the SPY, pull it up here. So the SPY over that same kind of time period, if we actually take a look at the, well, I guarantee you the SPY is not down 52%, right? But if we take a look and kind of pencil out, that'd be like a 2-year performance. So let's actually do that. July, where you at? July. No, I already passed it. July. Around there, whatever. All right, so up 22% over that same time period. So underperformance, yeah, pretty much a decent amount of underperformance. Now, we also have to consider that he's been adding to the position, and he's been adding to his positions at highs. So if you had just purchased the SPY throughout that whole time period, you would definitely not be down that much. So he is underperforming in that aspect. And then if we take a look at this other one where he showcases, I think, the story fund, not the story fund, the passive income, well, no, this one, sorry, the passive income fund. So this one actually performed at 15.42% since the measured date of December 18, 2017. They're already similar thing. You can see the 5-year, 65%. And if we do VT, which is the entirety of the entire market ever, it is Let's do 5-year. It is up 33.78%. So whatever metric you want to utilize, that's still, even on the VT, which is supposed to be the lower volatile asset, he's underperforming that. So that being said, where do we go from here? Well, let's actually see. This is the we'll start with the passive income fund, which is considered the more conservative one. This is the older one, and we'll see if there's any changes really. So in the core, he has 3 ETFs, and in totality, it makes up 30%. In the consumer, he has Costco, Disney, Home Depot, Nike, Target. When I witnessed all of his videos on these stocks, they were primarily story-driven. So I'm not going to get into it because it's primarily just story-driven. If I went one by one, I'll just go, it's story-driven, story-driven, story-driven. So an example, he was always... For Costco, he was hyping up, for example, the fact that the company is, making money from its subscribers. He basically goes in a tirade and explains the business, which is good. You want to understand the business. So he has that aspect down. It comes down to the analytical side where he's completely failing here, in my personal opinion, and he's paying nosebleed prices for all of these. Now, easier said than done because, not anyone can just be like a willy-nilly analyst and be like, oh, these are the right prices. It is more difficult to perform well. So Disney... Again, nosebleed prices. I made a video on Disney last year, and when the channel was really small, I got some flack for it. There wasn't many commenters at the time, so any bad comment was basically almost all the comments. And so Disney, someone was saying like I didn't understand the business, and I was like, okay, I mean that's cool. It's not okay, whatever. And Disney is now much lower. Disney was close to like $170-ish, and now it's what, like about $100-ish bucks. So at the time of filming this video. Actually, let me confirm what it is. I can see here. Yeah, it's $104. So it's basically lost all of those gains. It was tremendously overvalued, and I'm on record saying that. Home Depot, same thing. Nosebleed prices. Nike, nosebleed prices. Target, nosebleed prices. If you focus only on the story, you're going to pay nosebleed prices. Well, that's assuming that you're capable of even doing good fundamental analysis, because if you're not capable of doing good fundamental analysis, then you have a problem already there. So it's a little bit of a problem there. And I'm not trying to be mean. I'm just trying to statement of fact. Okay, statement of fact. Apple, Microsoft. I mean, so far, all these companies are good companies, by the way. Just want to clarify that. They're all great companies, but you're paying nosebleed prices for most of these. And again, I went through like his thoughts on those, similar reason. Here's where I have a lot of agreement here in terms of the prices. So Vici... Well, actually, I don't know what he paid for Vici, to be honest. But Vici, same thing when I saw story-driven. He literally read an article from the CEO of Store Capital and was like foaming at the mouth of how wonderful this company is. And that was an old video. But I will say this, Store Capital, which the CEO is now gone, by the way. He's probably going to start a new REIT. He actually does have a differentiated strategy from other REITs where he focuses on master lease agreements where he can basically see the entirety of the business or the tenant's business, which you can't really do for something like Home Depot. And then something like Realty Income is in there. I would actually take out Simon, if this was me, not financial advice. Take out Simon, wouldn't care about that one. MGM, wouldn't care about that one. Keep Store, keep Vici, keep O. Add maybe something like an ADC. Add something with medical. Probably take a look, but not add right now industrial. Maybe add some industrial because you don't want to really be a market timer, quote unquote. Just nibble in and do that. I wouldn't really care for MGM or Simon, my personal opinion. Banks, I like JP Morgan, don't like T. Rowe. I would add maybe Bank of America, maybe Citi in there, maybe some insurance companies, depending on what insurance companies. But T. Rowe is not my favorite of them, so whatever. Restaurant, I do like Texas Roadhouse. Now, this is the old portfolio. We're going to go into the new portfolio, so nothing bad to say about Texas Roadhouse. Unfortunately, the CEO passed away. Now, going to the core he was eliminated 2 ETFs, so let's revisit this. So the ETFs used to be... Let's see, large cap, dividend equity. So he's removed the technology because I guess they were underperforming. But yeah. Oh wait. Haha, it started working for some weird reason. All right, so now it started working again. So this pie, wow, it happened live. Is it working now? Yes, it is. Oh my God. Oh, it's not working here. Whatever. So we can see these individualized pies, unfortunately, but it's not working for the total, which is stupid, but whatever. So this one with the 3-year and the 5-year. Okay, so in the 5-year, if he had actually kept all of this, it actually is outperforming the SPY, this particular allocation. So pretty interesting. I think most of that is probably coming from large cap growth and maybe the dividend equity. Let's actually confirm. So just because I'm very curious now. So no, the actual dividend equity, yep, it did outperform. And I think technology right now has slightly underperformed, yep. And then this one has outperformed drastically, large cap growth, which I will make one day a video dedicated to that. But yeah, so core's done well, but he changed it out, and he's only having this. So now the proposed performance is still better than the SPY, but that's not his realized performance. So now consumer here, his estimated performance would have been 106.90, but the thing is he's probably fudged around, and the thing is he's played with the soap. He's played with the soap, because let's take a look at, well, this is not even that far away ago, by the way. I forget what the date is when this was pulled, but this is not too far away. What I want to highlight is if there's any differences. 5 positions, it's the same positions, and it looks like they're the same allocation. Yeah, it's the same allocation. So no change here, but the performance, again, this is more recent. This is the old one. The old one is still a recent one. So the changes don't reflect the real changes. So if he's been playing around with the soap, he's not going to achieve the full performance that this is saying, because this is actually going back in retrospect. The real performance is what he showcased in this one. It's 15.42%. Okay, so consumer, nothing's changed there. Tech, nothing's changed there. Real estate. Okay, so real estate he has removed. He has removed these companies, all of them except for Vici. Okay, I can respect that. He's trying to concentrate on Vici. I like Vici, but I liked the quality of it. I don't have REITs anymore. You guys know why, because I was actually in anticipation for the liquidity crunch. I don't have any REITs anymore, but I would like to get back some REITs. Okay, so food, he's added Starbucks, nosebleed prices, Domino's, nosebleed prices. Don't understand why, but yeah. And then if he had held all these for 5 years, he'd be underperforming the market. So you can see the restaurant sector, where his picks at least are underperforming the market at the present moment. In the past, let's see if they've underperformed the market as well. So restaurants as a whole have generally underperformed the market more recently. And when I say recent, last 5 years. Okay, so this is the same. All right, so now we're going to move over to the less good side of the portfolio. So this is the story fund. It's down about 52.28%. Abysmal performance relative to the market. We'll see why in a second. Like I said, even in the conservative portfolio, it's basically story driven entirely. And then when we go to the growth portfolio, what is this one? No, yeah, it's the story fund right here. Yeah. So the story fund, it is different now, by the way. So we're going to talk about it. It used to be this. So it's not going to show it. So whatever. But just if you scroll through this, I won't spend too much time here. But yeah, he has played with the soap drastically among these. And we'll see that now. Just remember some of these allocations, 12, 9 stuff. And then we'll kind of see together right here, story fund. So Netflix went up to 15, Amazon, Alibaba, he drew down as Alibaba was coming down, which is kind of funny because Alibaba, some of you have asked me questions like, what are your opinions on Alibaba? I have tons of opinions, tons of videos on Alibaba, tons of videos on VIEs. Everyone who's watched my channel for a long time knows that and I made a video saying I'm not going to talk about it anymore until they go up, because it's easy to kick them while they're down. I already made extensive videos when they were up higher that I did not like them. So I don't want to, this channel is not meant to rub in people's faces while their stocks are down. Okay. I have my opinions on Alibaba, and I've made a decent effort at making them aware. Okay. So if you're curious, go on the channel and find any of the videos on Alibaba. You'll get it. All right. So Amazon, he's made it 40%. Like the company, like the company, like the company. I like the company. I like the company. I like the company. I like the company. Don't like the company. I kind of like that company. So I like all his companies, right? What's the problem? What is the problem? I like all his companies. The prices he's paying for it. Because if you're a story-driven investor, you're probably going to pick good companies. You're probably going to pick fantastic companies. You are. Amazon's a good company. Netflix is a good company. Google's a good company. Microsoft's a good company. Salesforce, Adobe, Apple, Alibaba, Spotify. All these are good companies. For the sake of it, if we remove my opinions on Alibaba, Alibaba's a good company. Okay, so Alibaba is a good company if we remove my nuances, I guess, in that, and we don't take that into account, it is a good company. Okay, so the problem is the prices, because the analytical side is completely missing here. And each time I've viewed his videos, and again, I featured him in my Netflix videos because he's made like a transition. He's made some sort of adaptation with Netflix where you see him extremely bullish when the price is high. And as the stock price comes down, he gets cautious. You can tell by his sentiment, the way he speaks, the way he talks about it. And I'll say this one, it's starting in this one, April 21, 2022. So he starts to get cautious in this one titled, Bill Ackman Sells Netflix, My Thoughts. And from there, this is, I think, where I made the video around here. Now, this one is really interesting. So this one was given to me by a subscriber. Supposedly, the fair value estimation he makes for Amazon is like in the 4,000s. I was like, what? So for those of you who don't know my opinions on Amazon, you can go check out the Amazon video, and I share my opinions there on what the value of Amazon is. And that one got some dislikes when the price of Amazon was higher. So I don't know. But some people don't like it when you talk bad about their stocks, which is funny because it's a holding, but it's a reduced holding. All right. So anyways, overall thoughts. Basically, this guy picks good companies. And by the way, I just wanted to actually show this. So he doesn't have CrowdStrike anymore, probably because it went down. He doesn't have Twilio, probably because it went down. And he wants to focus on the good companies. He's reduced his Alibaba exposure. He has still Shopify, but reduced exposure. Because let's see again, reduced exposure. 6% and 6%. Spotify 6%. Spotify 3%. Okay, so he has reduced exposure. He's basically concentrated greater exposure to Netflix. What about Alphabet? Alphabet, 15%, slight more, but Amazon. Amazon was just absolutely just throwing it all in there. And he's probably was paying pretty high prices. I do like the companies, though. He's probably sold SE, he bought high, sold low. Snow, eliminated, bought high, sold low. DoorDash, bought high, sold low. Apple, he still has Apple. Yeah, he still has Apple. But he might buy high and sell low on that one. Microsoft, he still has Microsoft. Salesforce, he still has Salesforce. All right, cool. But that's all I have to say. He doesn't have this one. Altasun Corporation PLC. What the heck was even this? Yeah, I don't even know. I don't even know this company, to be honest. It's one of the ones I don't know. Software company in London. All right. But yeah, I don't know this company. So yeah, that's pretty much my overall thoughts. He's a good case study to kind of witness, and nothing against the guy. And like I said, I defended him on the stream last night when someone was saying he was a scammer. I don't think he's a scammer. He's not that degree. We've covered, I'm not going to name who, but you guys know who. We've covered some scammers. We reviewed at least one, and I'll say only one. Of the ones I've reviewed so far, I only believe one is a scammer. You guys use your imagination to guess which one. This Joseph Carlson would not be put into the scammer category whatsoever. I think he's genuine. I think he shows his portfolio. He may be wrong. I may disagree with him on the way he does things. And this is the last part where I'm going to show you guys in this video. And I'll be quiet. And I think it's in this one. 220. So we're going to go to minute 220 and listen to what he has to say.
Cash flows and all that financial jargon, the present value of all future cash flows that company will produce over its lifetime may be discounted for a certain risk factor. So that is really what a value investor is looking at when they make.
No, wrong. I want to correct that. Not what a value investor is. It's what an investor is looking at. It's what an investor is. Regardless of any company that I'm actually put to task with, if it's a private company, if it's a publicly traded stock, if it's a real estate property, okay, commercial or private, not private, residential, commercial or residential, it's kind of the same thing. You do pro formas. So regardless, he's right on that, but the nuance there is you might be doing it incorrectly. You might be using a lackluster evaluation process. So there's infinite ways to create these valuation models, these valuation metrics. Everyone's going to have their own twist to it, but that doesn't mean that everyone's is good. Okay, very important. Everyone's is not good. For example, I trust that he actually does come up with those valuations for these companies. I absolutely 100% believe that. But that is more of a reflection of the quality of the model. And, it takes a little bit to build one. It does take a little bit to build one. There's a lot of nuances, a lot of understanding that goes into it. And even then, it's a tool. And it's a good example of why evaluation models are tools. They don't make a good investor. They don't. They really don't. They help a good investor become better. But they don't make a bad investor become good. That's not how it works. And you can't automate these things yet because a machine cannot imagine. It doesn't have the capability for imagination. So until then, we still have investors who can outperform what a machine can do for companies, particularly companies. And until we get a machine to have imagination, then we're still in the green. We're still good. All right, so then there's the next bit. So I just want to comment just on the PV statement. He's right into the terms of the theory, the terms of the academia. That's all right. He's using the right definitions. The nuance that's lacking there is, well, what are you doing? Like, what are you doing to get an Amazon fair value estimate of $4,000 right now? Like, what are you doing? I don't know, but...
Any investment. They're looking at the future cash flows. And all that financial jargon, the present value, future cash flows, is a way of saying that when you invest in any company, whether it's Google, Amazon, Microsoft, or Netflix, you're not just buying a streaming service, you're not just buying...
Beautifully stated. You see, but that's what I'm saying. Joseph is a master at the story. I'm watching his videos, and he is one of the best storytellers I have seen in stocks. Very good. Excellent storyteller. And in fact, I was watching some of these videos. I couldn't help but come out of the video thinking, like, if I wasn't thinking hard enough, I would be way more bullish on these stocks, which is dangerous. And it's not saying that he is like trying to do it maliciously. He's not. So that's why I want to make the separation. Joseph is not maliciously doing anything harmful, okay? What I would say as he is wonderful storyteller. Like, I can't stress that enough, guys. Very good storyteller. Where if you're not, I guess, like some of my subscribers that have requested this, you guys are accountants. I know you guys are accountants. I'm not doxing you or anything, but you guys are accountants. You've worked at, I know one of you has worked at a big four firm. You've looked at publicly traded companies, their books at least, several times, many times over. So you are more or less familiar. You're kind of numbed to this at this time. So imagine, take yourself out of that experience and then make yourself some random person who doesn't really have experience with the financial markets. Listening to him is wonderful. It's like, wow, such a beautiful tale of Amazon, the wonderful company, which in investing, it is important to have that aspect. I believe in a balanced approach. I believe in analytical mixed with the story driven. You must understand the business. You must, to an extent, love the business. I would not invest in a company unless I do like the business, right? Because then that helps me not make mistakes. However, there is such a thing as being blinded by such affection, which I think is very common for people who are more story-driven investors. And I think Joseph is a story-driven investor. That does not mean he cannot be successful, because in instances where he buys a company, his evaluation might be, terrible, right? Let's just say his valuation is terrible, but he's buying a fantastic business. Just so happens that he might accidentally be buying it at a good price. He might do well, okay? And if he won't get absolutely destroyed, like he won't experience a 90% loss if he buys what are fantastic businesses. For example, I don't think personally that Amazon would collapse 90+%, right? So he's not going to have that experience, okay? Because he is buying quality. In my opinion, I cannot objectively state that any of his companies in the current portfolio are garbage. I can't. I really can't. That the same cannot be said for another individual. Okay, the same cannot be said for other people I've reviewed their portfolio on, particularly one individual. And I think you guys can use your imagination on who that individual is. So it's just a disagreement on when he purchased, which does affect your performance over long periods of time. What you pay for an asset matters, and I think he has his opinion on the value of these assets. It's just, in my opinion, going to be wrong. But it's a market; everyone has differing opinions on that. Okay, so next tidbit is at 834. So let's find 834. Oh, we'll just put it before.
Jeff Bezos is one of them. But the question still remains, what do we really focus on? I know a lot of investors are just blasted with information. We have PE ratios and price to sales and different valuation metrics. We have different things like the profit margins of the business. We have the revenue growth, the EBITDA, the free cash flow, the net income.
Okay, real quick comment. Two comments that I wanted to have here. One, this is his software, beautifully built, I would say. This is beautifully built, okay? I think he has a background in software development, so I want to just comment that saying great work. One thing I will say is that, well, you say that, and then you flood the main page with it. So if you don't want to be distracted with all that stuff, don't flood the main page with that. So like, for example, I don't know how much information I should really reveal, but yeah, I don't want to like reveal too much. But okay, so EBITDA, I don't care about that. I don't care about that. Throw that away, please. Throw that away. Free cash flow, you can keep that. Net income, keep that. Cash, keep that. Debt, keep that. Revenue, keep that. Price, keep that. Dividend, yeah, whatever, keep that because some people like the dividend. I don't know what the other shares outstanding, keep that. I don't know what the one in the bottom left-hand corner is, but let's see. Does he go down? All right, I want to see. But basically, he says that people get distracted with all these metrics, and I'm like, okay, well, you put the metrics in your own software, so that means like you're paying attention to it. So just a little funny thing. That's not like to haha hoo hoo. No, it's kind of just funny for me that he said that. And yeah, my only complaint is actually EBITDA. I only use EBITDA for one thing at work, one instance or one set of instances that the average person is never going to do. So it doesn't make sense. Okay. Companies love to use EBITDA. I'll tell you that there is a scenario in which EBITDA and enterprise value to EBITDA would really matter. I actually do use enterprise value more often than people think, but I don't use EBITDA too often. And ask any accountant, please, how they feel about EBITDA. Well, not every accountant will agree with the same thing, but ask any accountant, leave an open question, or I'll leave the open question. Any accountant who's watching and is a subscriber of the channel for quite some time, please share your thoughts down below. What do you think about EBITDA? State that you are an accountant, and yeah, so, but also everyone's open. I want everyone to answer. What do they think about EBITDA? We've had these conversations before. So that's kind of closing off my personal opinions. So conclusion, Joseph Carlson seems like a genuine guy. Would not classify him as fraud. So I did defend Joseph, even though I don't know him. I did defend him on the live stream last night from one particular individual. I don't think he's a fraud. I think that he is trying. This is his hobby. I don't know if it's full-time income. It might be his full-time income, but regardless, you know, I'm not someone who's like, oh, you know, you have to be an industry professional to even be talking about this. I don't believe in that. Whatever. That's argument from authority, first of all. He could be a non-industry professional and be right on things, right? So that's stupid. But anyway, I think that he's trying to be upfront. He shows his portfolio. What matters at the end of the day, by the way, in terms of transparency of allocation, is that he does this. He's doing it. This M1 Pi. All that matters is you tell me your allocation and yeah, how much you have in it. That really just shows me everything I need to know. To be honest, when he does this is the misleading thing, the value over time. I wouldn't show that because that's misleading. That shows, it makes it look better than what it is. What you should really care about is the return there and the allocation there. That's it. That's it. That's really it. Okay. Other than that, just all the businesses I see in the current iteration of the portfolio are good businesses. My only contention is the price. So we have now witnessed two investors in the portfolio review series. One is story driven and the other one is analytical driven. And we can see how you can see both extremes. And I quite literally I believe that. They are literally the two opposite ends of the spectrum. And they are, you know, both underperforming in my opinion. Well, not in my opinion. I think objectively they're underperforming right now. So I think that as you guys, the audience, what you guys can take from this is you want to get some of him and some of the other, merge them together, and then throw your own flavor as an investor, and then that's how you're going to be successful. Okay, or you just do index investing, and then you're fine too. So, well, you're fine. Yeah, whatever. All right. So on that note, guys, thank you guys so much for watching, and I will see you guys on the next video.